Hi, my name is Lisa Cummings, and today I'm going to share with you some information about a cash balance plan investment strategy. Before I share with you that particular information, I want to provide you with a bit of information about our law firm. Our law firm is Cummings and Cummings Law. Our website address is www.cummings.law. We are a full service law firm. We assist businesses as well as individuals with all of their legal needs, focusing in areas such as business planning, business transactions, as well as estate planning and planning for retirement, whether it's a company that's assisting its employees plan for retirement or an individual who is providing information regarding an estate plan design. A little bit of information about myself. I've worked throughout my career with large companies and assisted them with their retirement benefit programs as well as certain compensation and executive design for individuals throughout very large companies and smaller companies as well. Today, I'm going to share with you a little bit of information about investment strategies. If you have a cash balance plan, your investment strategy should not look like your 401k strategy. A cash balance plan has typically a much shorter time horizon, and it also has a promised crediting rate. And there are real funding consequences if markets swing the wrong way at the wrong time. In the next few minutes, I will show you how cash balance plan investing typically works, why minimizing volatility is not conservative, it is strategic, and also how to align investments with a plan that is often designed to run for a very defined, specific period of time. So, the goal in investing for a cash balance plan is to minimize volatility and simultaneously match the liability. So, first, a refresher regarding some quick plan definitions of a cash balance plan. A 401k plan is a defined contribution plan. Employees typically will defer their own compensation, and the employer may choose to add matching contributions or profit sharing. The participant's retirement outcome depends upon those contributions and the investment performance of the individual's 401k account. That is very different from a cash balance plan, which is a defined benefit pension plan. That cash balance plan is truly a pension plan, but is presented as an account-like format. Each participant has a hypothetical account that receives each year a pay credit, which is usually a percentage of compensation or a flat dollar amount, and an interest credit, which is a stated rate that is defined upfront by the plan. The cash balance plan is typically funded primarily by the employer. So it is the employer that is defining what the pay credit will be for the underlying employees, as well as upfront what they promise that that cash balance plan will deliver as interest credit whenever that individual reaches retirement age. Cash balance plan being funded by the employer is all about actuarial calculations as well as an annual funding analysis, which has to be undertaken by a licensed actuary. So if you remember one thing, remember a 401k plan is flexible. It is a very familiar savings platform. It is different from a cash balance plan. The cash balance plan has a pension engine that can often allow larger deductible contributions on the behalf of the employer when the underlying demographics of that organization fit a cash balance plan unique dynamics. In the investment of assets of a cash balance plan, the underlying investment has to be viewed as a management of a liability because that promise of the organization to the plan participants becomes a liability on the organization's balance sheet. So investing assets of a cash balance plan is not about chasing the highest rate of return for that particular asset. It is more about managing truly the return for that liability. Very different. A cash balance plan truly is a defined benefit plan. Even though it feels a little bit like an account balance plan, this cash balance plan is making a promise, usually stated as a pay credit along with an interest crediting rate. That means that the organization is not just investing assets. It has a liability which it has to manage and reflect on its financial statements. So here you are investing a fund of dollars, which are a liability on your overall organization's spreadsheet. What the plan expects to owe to participants over a relatively shorter period of time, that can be taken into account. The first mindset shift is this: when investing the cash balance plan contributions, you are not trying to beat the market. Instead, you are trying to fund the benefits predictably in compliance with IRS regulations while avoiding surprise contributions. Volatility is in the overall investment environment is very important, especially when it comes to cash balance plans. Volatility from a market perspective is not just uncomfortable, it can also become very expensive. This is why. If the plan assets, so that's what the organization has contributed up to this point to the cash balance plan. By the way, those are set aside in a trust account. If the plan assets drop materially in their value, the plan sponsor, that's the organization, may need to contribute more than is expected in order to stay on track with the IRS required minimum funding requirements, along with the plan's promised benefit formula. In a 401k plan, a down year is a participant issue. So the participant may see that their 401k account balance has gone down. Contrast that with a cash balance plan, a down year becomes an organization, company cash flow issue, especially if the plan is relatively mature, if the benefits are going to be paid out soon, or if the organization plans to terminate the plan within a predictable window of time. Interest crediting rate. So whenever a cash balance plan is first established, the interest crediting rate needs to be decided up front. And in that deciding, then the actuary as well as your counsel will help you decide on an investment benchmark that you must respect, and it becomes stated in the plan document. Most cash balance plans will define an interest crediting rate that is like the plan's internal benchmark. Common examples include a fixed rate, a treasury-based rate, or another permitted index. Investment strategy should be designed with that crediting rate in mind. If your plan credits, for example, a rate that behaves like intermediate treasuries, it usually makes little sense to invest plan assets if you are running a 30-year equity portfolio. Usually those intermediate treasuries are working along the lines of maybe 5, 7, 9 years, a much shorter period of time. You want assets that will track the nature of the promised crediting rate and the timing of the benefits. For an example, why too aggressive of an investment can backfire. Assume your plan's interest crediting rate and benefit growth effectively mean you need about a 5% annual return to keep contributions stable over time. You decide to invest aggressively, expecting for an 8% long-term return with stock-heavy portfolio. However, unfortunately, in year 2, the markets dropped 20%. and your assets, which started the year at $1 million, are now only worth $800,000. Your benefit liabilities did not fall 20%. In many cases, they keep growing based upon the plan formula and the crediting rates. So what happens? Your expected contribution is no longer enough. You, the organization, may need to make an additional catch-up contribution at exactly the time that you least expect or wanted. So the takeaway is this: in a cash balance plan, the pain isn't just a performance. The pain is timing with unexpected organization contribution pressure. In this example of explaining why overall investment volatility can create contribution surprises, remember a defined benefit promise, because that's what the cash balance plan is. A defined benefit promise and a very short horizon can result in a funding risk if the underlying assets are invested and result in an asset swing at the wrong time. So in this particular example here, you will see if the plan started at the very beginning when it was established, say it was worth $100,000, and then in year one, great, the investment return grew, and there was now $105,000, and then lo and behold, look what happens in year two, and here it looks like the funds are now only worth approximately $82,500 as opposed to the original $100,000. And then you'll see that even if over a period of time the assets start returning, that regardless of what the plan assets are, the plan liabilities, this is the organization's commitment to the participants and the IRS, is that at the particular point in time when the individual gets ready to retire, that amount of money will be available for them. So that would mean that particular year, in this year four, then the organization is going to be way behind on what would otherwise need to be funded. And keep in mind, the actuary ensures on an annual basis that any additional funding which is required by the organization is contributed at that time. So again, cash balance plans, credit benefits by a formula. Investment drops do not reduce the promised benefit. When assets fall, required contributions may need to increase to keep the funding on track. And then short horizons amplify the bad timing. So here, keep in mind, you are managing a liability. Less volatility can mean more predictability in the employer contributions. Some practical investment approaches that will minimize volatility are, first, a liability-driven investment, or sometimes you'll see the initials LDI. That means that you build a portfolio that behaves like your plan's liabilities, often using high-quality bonds with durations that match your expected payout timing. Or you could have some type of a bond ladder, which is short to intermediate maturities to reduce the reinvestment risk and smooth results. If the benefits may be paid, say, in a 3 to 7 year period of time, the portfolio can be structured to mature into these windows. Another strategy is high quality, lower drawdown, which will result in investment grade fixed income, diversified bond exposures, and risk controls that are often consistent with the plan sponsor's objective: fewer funding surprises. The fourth strategy is called a de-risking glide path. Early years might tolerate some modest growth exposure, but as the plan matures or reaches a planned termination window, the portfolio gradually shifts more to a conservative investment stance because the time horizon is shrinking. This particular example will show you about how the assets of a cash balance plan may be invested if they are de-risking over a period of time. So in the early stage, there may be a split of the underlying investments. Say 45% would be invested in equities, and then another 45% invested in bonds, with 10% invested in cash. And then, as this particular cash balance plan gets closer to having to pay out those promises, then you'll see more and more of the assets being shifted to cash and to bonds, typically viewed as the more stable underlying investment. Your actuary for your cash balance plan will help you think about these items. How long is it until there are going to be required payouts at retirement? What is the crediting rate that is stated in the plan document itself? And what is the underlying investment policy for the plan? Typically, if you are an organization that is ensuring that you can deliver on the commitment that you have made to your participants in the IRS, you will have this mindset where you are managing the liability along with the return, or what's called a liability-driven mindset. So you understand what the liabilities are, you match the underlying investments with those liabilities with the goal of fewer funding surprises. The termination horizon is always, in a cash balance plan, typically planned from the beginning. Most cash balance plans are established with a rough time horizon in mind, maybe 5, 7, or 10 years, depending upon the business goals and the workforce design. If the termination is a realistic future event, then the investment strategy should reflect that. As termination approaches, you want assets that can convert to cash efficiently and align with the settlement options. Often, an annuity purchase pricing or lump sum funding requirements, depending upon the plan design that is stated in the cash balance plan document. In plain language, if you might need the money sooner than later, investing like it is forever money can create an avoidable risk. So some practical next steps. If you want a cash balance plan to work the way it's supposed to work, with the organization making high contributions, with predictable tax deductions, stable funding by the employer, which has to happen on an annual basis, then as an organization that is establishing this cash balance plan, you need an investment strategy designed for a defined benefit promise with a shorter time horizon. Some next steps: identify your plan's interest crediting rate and expected benefit payout timing, working with your actuary and counsel. Work with your actuary and investment advisor to ensure that your assets closely track your liabilities. And if your plan is within 3 to 7 year window of higher payouts or potential termination, consider a de-risking glide path now. Move to more conservative investments now and not later. If you would like to provide me with any additional information or ask me any questions, feel free to send me an email, lisa@cummings.law. Thank you so much for joining us today.